Good evening, everyone. So welcome to our revision class today. So we're revising on taxation of business income. So I want to review a few questions on business income. And if time allows, we'll also look at another area. So basically, when it comes to business income, there are a few things you need to know. You need to know what we call taxable business income. Those items that are considered to be taxable from business income. So one is a gain arising from buying and selling. So when you buy and you sell, the difference, the profit that you generate from buying and selling, maybe you are buying commodities or you are selling services. So the profit, the gains from that kind of activity, they are taxable. And then when you receive insurance compensation for the loss of revenue items or stock items, that one is also considered as taxable business income. Foreign exchange gain is also considered as taxable business income. If the question writes miscellaneous income is also considered as taxable business income. Discount received is also considered as taxable business income. So those are majorly the taxable business income. That is income arising from the trading activities, compensation in relation to the business, inventory items, and revenue items. That is considered business income. You're also supposed to know non-taxable business income, what we call non-taxable business income. Non-taxable incomes. So one thing you need to know is that the income statement that is prepared for accounting purposes differ with that of taxable of the tax purpose. The income statement for the internal income statement that is prepared for accounting purposes is different from that one that is prepared for tax purposes. So for the purposes of internal affairs, they even consider some other income that the taxman does not consider to be taxable. So we call them non-taxable income, maybe a gain arising from disposal of capital items. A gain arising from disposal of capital items is not taxable, it's non-taxable income. So that one is not considered as taxable income. So when you sell non-current asset at a profit, that one is not considered as taxable income. And then there is what you call unrealized foreign exchange gain. Foreign exchange gain, this one is not taxable business income. Unrealized foreign exchange gain. So when you're trading internationally or you're using different currency than the Kenyan currency, sometimes the currency favors you and you gain. So this gain, until you receive it, is not taxable. To unrealized means you've not yet received the gain from the foreign investment as a result of foreign exchange activities. So unrealized foreign exchange gain is non-taxable business income. And then compensation from insurance company for loss of capital items. So when you lose capital items and then you are compensated for that, it's not taxable business income. And then another non-taxable business income is sale of shares. Sale of shares is non-taxable business income. Issue of debentures is non-taxable business income. Issue of debentures, and then reduction in general provision for bad debts. In general provision for bad debts. So there's what we call general provision for bad debts. So when it reduces, it is not, for accounting purposes, it's considered as income. So remember, provision is just an amount that is set aside from profit to cater for bad debts. So this amount can be, you can set for instance, 20,000 in a particular period. And then from analysis, you find that debtors are paying more and more. So there's no need to hold this money in that account of provision for bad debts. So you need to reduce amount by 10,000 to bring it back to circulation. So ordinarily, when you do that for accounting purposes, that one is considered as taxable business income. But when you do it for tax purposes, is not taxable business income, is not. And then another thing that is not taxable business income here is recovery of bad debts in relation to capital item. So when you recover bad debts that you for the sale of capital items, that one is not taxable business income. So you need to know that. Then very important also is what we call allowable and disallowable expenses. So allowable expenses are those expenses that assisted you to generate taxable income. And basically most of them are of revenue in nature. So those ones are allowed by taxman to be deducted from your gross income. However, for accounting purposes, they consider a variety of expenses, including some that are not allowed. So there are some expenses that are not allowed. So it is very easy to know disallowed expenses. So if you get that the question that you are disallowable expenses, so when the question has given you the net profit, for you to adjust the taxable income, you need to analyze all the expenses that were deducted. Those that are not allowed, we call them disallowable. You add them back to the profit that you're given. So there are some expenses you need to know of. We call them disallowed. One of them is depreciation. Depreciation, impairment loss or impairment loss. Impairment refers to the loss of value of intangible assets. Depreciation is the loss of value of tangible assets. And then capital acquisition. When you acquire a capital item, the amount of money that you use to acquire a capital item is not allowed. Number 3, personal expenses are not allowed. Personal expenses. Number 4, taxes and any expense related to tax. Any expense that is related to tax is not allowed. Tax and any expense that is related to tax is not allowed. Number 5, donations, except donations to charitable institutions. Charitable institutions, we're talking about mosques and churches and children's homes. Any other donations, maybe to a relief fund or to any other donations, are only allowable if they are to a charitable institution, to a mosque or a church. Any other donations are not allowed. Donation to political party, for instance, are not allowed. Donation to farmer and relief are not allowed. But donation to a charitable institution, to a children's home or Red Cross, that one is allowed. But donation to a farmer and relief is not allowed. To a political party is not allowed. Number 6, penalties and fines. Penalties and fines not allowed. Number 7, penalties and fines are not allowed. Number 7, legal costs. Legal costs in relation to lease agreement of over 99 years. That one is not allowed. Legal costs in relation to a lease agreement over 5 years. Items like cash embezzlement by a cashier or one of the workers, that is not allowed. And among others. So you need to have a clear grasp of allowable and disallowables, and then taxable and untaxable income. Once you have that, these questions are very easy to do. So we want to look at a few of them here. Both partnership and company. So we want to start with May 2021, question number 5C. May 2021, question number 5C. So block revision, May 2021, question number 5C on partnership. May 2021, question number 5C. So our first question is May 2021, question number 5C. This question was done last sitting, and it is on partnership. So we're going to read the question and do it together. In case you don't have the question, you can just be attentive And then you can request for it immediately after the class. You can call me and then I can forward the question to you. But in the meantime, you can just be attentive, follow up, and maybe you can ask a question if it's something that you don't understand. So I'll read the question. Mark and Wangu are in trading partnership operating as Mwaha Enterprises and sharing profit and losses in the ratio of 2:3 respectively. So the following statement of profit or loss was prepared by the business for the year ended at 1st December 2020. So we've been given there the profit and loss. The profit and loss, I know it constitutes of incomes and expenses. And then you have been given there the net profit of 99,4,500. Additional information number one says gross sales include VAT at 14%. In addition, 10% of sales before VAT represents closing stock. The stock has been overstated by 20%. Note number two, the amount due to partners are to be apportioned according to profit or loss sharing ratio. Number three, general expenses comprise partition of business premises, 64,000, debt collection expenses, 36,000, purchase of office stationery, 14,000, cash embezzled by partner's wife, 48,000, bad debts written off, 24,800, business premises rent, 31,200, salaries to employees, 106,000, total 324,000. Number four, legal expenses include acquisition of patent rights, 24,800, drafting of sales agreement, 34,200, negotiating sales contract, 60,000, drafting the business against trade disputes, 42,600, defending partners against wrong tax assessment, 94,600, conveyance fees for business premises, 125,800, tax consultants fees, 72,500. Number five, the purchases represents 40% of the gross sales figure of 2,736,000. The purchases had been understated by 25% and were omitted from the income statement. So required, required Roman number one, adjusted partnership statement of profit or loss for the year ended at 1st December 2020, 8 marks. And then number two, the allocation of profit or loss computed is here above to each partner, 4 marks. So they want us to adjust the taxable profit. So you write the title. The title is More Enterprise. More Enterprise. More Enterprise. More Enterprises. Computation of taxable profit. Computation of taxable profit, year of income, 2020, and then you underline here. So here you can write shillings. So now, when you're doing this kind of question, the first thing you check is whether they have already given you the net profit. The question has already computed the net profit for you, or you are the person now computing the profits, the gross profit. If the question has given you the net profit, you will add back disallowable. So you'll analyze the expenses deducted in arriving at the net profit, and then those ones that are not allowed, you're going to add back to the net profit. If the question wants you to compute the gross profit, you'll compute the gross profit and then identify other taxable business income you add to the gross profit. and then you pick allowable expenses amongst the list of expenses you'll be given. So here, the question has already given us the net profit. So we start with the reported. We start with the reported net profit. It can be profit or loss, irrespective. Just put the figure here, 994,500. If it is a loss, you put in bracket to indicate that it's a loss. So the reported, and then you go back, you add disallowable, deduction. So these are deductions that were deducted in arriving at the profits, but they're not supposed to be deducted. So how do you identify this one? So you go directly to the expenses deducted. So there, the income statement, they have clearly indicated the less expenses. You can even ignore additional notes. So once you pick expenditure there, you check alongside the additional note if it's if there is any note affecting that particular expense that you picked. Once you pick a particular expenditure, you either certify it as whether allowable or disallowable. And besides, you also check alongside the additional notes to find out if there is a particular note that is affecting that particular expenditure that you're dealing with at that particular time. So the first expenditure there is general expenses. Ordinarily, general expenses is allowed. So you check if there is any expenditure, any note, sorry, that affect that general expense. Like the note number 3, we have general expense comprises of partition. So you have been given the breakdown of general expense, what it comprises of. So it comprises of partition of business premises. That one is not allowed. Partition is a capital item. So you add back partition of business premises. Partition is not allowed. So you add back 64,000. That one is not allowed. And then it also comprises of debt collection expenses. That is allowable. That is related to business. And then purchase of office stationery. Office stationery is allowable. It's related to business. And then cash embezzled by partner's wife. So embezzlement is not allowed. Embezzlement is not allowed. So cash embezzlement. Cash embezzlement is not allowed. The amount is 48,000. So you add back 48,000 here. Bad debts written off. Bad debt is allowable. Bad debt is allowable, but what is not allowable is general provision for bad debts. But bad debts itself is allowable. Business premises rent is allowable, and salaries to employee is also allowable. So out of the total amount for general expenses of 324, these 2 items are not allowed. So you add them back. You go to the next expenditure, which is legal expenses. Ordinarily is supposed to be allowed, but you go to the additional notes. You find out if there is an additional notes affecting that legal expenses. Note number 4 says legal expenses include acquisition of patent rights. Patent right is a capital item. So patent rights, that one is not allowed. So you add back 24,800. That one is not allowed. Drafting of sales agreements, that one is allowed. Negotiating sales contract, that one is allowed, it's related to business. Drafting the business against trade, defending the business against trade dispute. Trade dispute is not allowed. Trade dispute. So any legal cost in relation to trade dispute is not allowed. Any legal cost in relation to trade dispute is not allowed. 42,600. Mortgage interest for Mark. So when it comes to partnership, any benefit that's any payment in regard to the partner's benefit, that is partner is to benefit the partner is not allowed. So mortgage interest here, mortgage interest. So this is for Mark. That is not allowed. How much is it? 140,000. 140,000. And then defending a partner's around tax assessment. Wrong tax assessment not allowed. Wrong tax. Any expenditure that is taxed is not allowed. 94,600. Conveyance fees not allowed. That is tax. Conveyance fees. 125,800. Tax consultant fees. Tax consultancy fees not allowed. So that is 72,500. So that one you add back. So after that we have salaries to partners. Salaries to partners not allowed. Salaries to partners not allowed. 450,000. Drawings by partners not allowed. Drawings not allowed. 100,000. Commission to partners not allowed. Commissions to partners not allowed. Any payments to partners not allowed. Commission to partners not allowed. Commission to partners not allowed. 250,000. So you add back 250,000. Interest on partners' capital not allowed. Interest on partners. Interest on partners' capital. 250,000. Sorry, interest on partners' capital. The commission is the 180,000 here. This one is 250. Purchase of furniture not allowed. Purchase of furniture not allowed. Purchase of furniture 96,000. Donation to poverty commission not allowed. Donation to poverty commission. Donation are only allowed to charitable institution, so that one is not allowed. We have construction of fire exits. Fire exits, that is a capital item. Fire exit, that is a capital item, 36,400. So out of those expenses that were deducted, those ones are not supposed to have been deducted. So we call them disallowable expenses. So we add them back. We add them to, they're supposed to be they're supposed to be added to the profits. So we check other notes. We had some other notes. We see whether how they affected the profit. For instance, note number, before we can proceed, we check note number 1. Note number 1 says gross sales include the VAT at 14%. In addition, 10% of sales before VAT represents closing stock. The stock had been overstated by 20%. So when you include VAT in sales, it means the VAT has also been treated as income. So it means it has inflated your sales value, which means you have enhanced your profit. So that one is supposed to be deducted. So VAT is not an income. When it is included in sales, it's supposed to be deducted. So now what it means here, so we have the sales figure here. The sales figure, the total amount of sales figure is 36,000. So according to the question, according to the instruction, according to the instruction, this figure here is equivalent to 114%. It is inclusive. So we want to know what was the VAT amount, 14%. We're going to deduct it from. So we take 14 out of 114 times 2, 736,000. We want to know how much was the VAT in that amount. We want to know how much was the VAT in that amount. So this one is going to give us 14 divided by 114 times 27, 36,000. So this is 336,000. 336,000 is the VAT amount in the sales. So then the net sales without VAT, net sales without VAT is going to be 27, 36,000 minus 336,000. So this one is going to give you, so 2273, 6,000 minus 336,000. So this is 2,400,000. So this is the value of sales without VAT. This is the value of sales without VAT. The same note says that in addition, 10% of the sales before VAT, sales before VAT, which is this one, that is 22,400,000, before represents closing stock. So closing stock here. So this is closing. We are dealing with note number 1. So closing stock here is going to be 10% of 2,400,000, which is the same as 240,000. So that is the closing stock, 240,000. It has been overstated by 20%. So this figure here, this figure of 240,000, which is the closing stock, is overstated by 20%. So in other words, it is same as 120. So when you overstate your closing stock, what is the implication to your profit? What is the impact to your profit? When you overstate your closing stock, the impact is it enhances your profit. For instance, just let's do a simple analysis here. For instance, if you have your normal sales to be 10, that is your normal sales to be 10. And then you have your normal opening stock to be 2. And then purchases here to also to be 2. And then closing stock is 1. So the normal gross profit, which is our profit, 2 plus 2 before minus 1, it will be 3. So our gross profit here, normal one, will be 7. Now, supposing we overstate our closing stock by any, the impact is the same. We overstate it by either 1 digit. So instead of indicating as 1, we indicate it as 2. So it will be 2 plus 2, which is 4 minus 2, which is 2 here. So if you overstate your closing stock, then it means the overstatement is treated as income. So both these two items here, we're going to deduct them. We're going to deduct them from this profit. So the VAT in sales and the overstated closing stock, that is note number 1. And then we go to note number 5. Note number 5 there. So let me repeat for the sake of those ones that might not be following. We are saying note number 1, they have told us that the sales value indicated in the income statement, this value here, includes VAT of 14%. So it means it's equivalent to 114%. So the VAT in sales, VAT is not sales. So when it's included in sales, we need to determine it and eliminate it from sales. So when you inflate any figure in the sales, then it means you've enhanced your profits. So that one, we're going to deduct it from the profits. So here you have come and determined the 14% of this, the VAT amount in sales, which is 336,000, by cross multiplying. And then now we need to get the net sales. So the net sales is 2,400,000. So you take the sales value minus the VAT. This is the net sales. And then out of this total net sales here, 10% of it represents the closing stock value. 10% of the net sales, in other words, sales without VAT, represents the closing stock, which is also overstated by 20%. According to analysis here, simple analysis, which you can be doing in case of overstatement, it tells us when you overstate the closing stock, it means you have increased your profit. So that one is also an item to be deducted. And then we also go to note number 5. Note number 5 says the purchases represents 40% of gross sales figure, 27. So here, this is note 1. This is note 1 here. This is working for note 1. And then note 5. Note 5. So note 5 says the purchases represent 40% of the gross sales. So the purchases figure is 40% of the gross sales plus VAT. So 27, 36,000. So that one is give us the value of purchases. So let us first get the value of purchases. Let us first get the value of purchases. Let us first get the value of purchases. Get the value of purchases. So that is 1094,400. So 40% is 1094,400. So 1094,400, that is the purchases. So what about it? The purchases had been understated by 25%. So this value here, this 1094,400 is equivalent to 75%. So when you understate your purchases, let us go back to our analysis here. We have said that purchases, the normal purchases to be 2. So let us understate it by 1. We want to see the impact on our gross profit. So 2 plus 1, that is 3. Minus 1, that is 2. So 8. So when you understate your purchases, then it also means you've treated that one as an income. So you have treated that one as an income, so you're supposed to deduct. So all those items, they are deductible items, we're going to deduct. So that is how we do it. And then we continue. So after dealing with the expenses, you come here and you less omitted allowable deductions. So there are those deductions that are supposed to have been deducted, but they are not yet deducted. How do you know them? They are not among the list of expenses, yet they are supposed to be there. So the expenses that are supposed to have been deducted, but they are not deducted. Why? They were omitted. Investment allowance. So you write here investment allowance. The first item there we have is, furniture. So you take their furniture. So they did not claim investment allowance on furniture because it is not indicated in the list of expenses. So the rate is 10%, and the value of furniture that was acquired is 96,000. So you claim or you deduct that one. So that one is 9,600. You deduct that one. So they also partition. It's also 10%, and the total value for partition is 64,000. So 6,400, you also deduct that one. And then they also hide fire exits. Fire exit, that is a building, so which qualifies by 10%, 10% of 36,400. So that one is 364, 3640. So you deduct that one. So that is investment allowance, it was omitted. And then after that, you less non-taxable non-taxable income. So those items that are treated as income, yet they are not taxable. So one of them is VAT in sales. So you less VAT in sales. We have already determined it is 336,000. So 336,000. So you less it. And then you also less overstated closing stock. Overstated closing stock. Overstated closing stock is 20 over 120 times 20 over 120 times 240,000. 20 over 120 times 240,000. 20 over 120 times 240,000. So that one is 40,000. So you deduct 40,000. And then there is also understated purchases. Understated purchases, which is 25 over 75 times 1094 400. 1094 400. So understated purchases, so 25 divided by 75 times 1094 400. So that one is 364 800. So 364 800. So that one you deduct. And then the next item those are non-taxable business income. Then you go to the list of income that were considered for the period. So we also have unrealized foreign exchange gain. That one is non-taxable. So you less unrealized foreign exchange gain. Unrealized foreign exchange gain, which is 16,000, that is non-taxable. So you deduct that one. And then insurance, okay, over provision for bad debts, over provision for bad debts. Over provision for bad debts, which is 34,000, so you deduct that one. Over provision for bad debts. And then interest on drawings. Interest on drawings. That one is non-taxable, 45,000. And then you less income from specified sources. So these are income that are taxable, but they are not supposed to be included together with the business income. So they are specific income, they are also taxable. So in Kenya here, 5 sources of income are considered taxable income by the government. One of them is employment income, investment income. Investment comprises of interest and dividend income. And then we have farming income. We have rental income and business income. So those are the 5 sources of income that are considered taxable in Kenya. So when they are there, each and every source should be indicated separately. You don't mix them together. You don't combine them together. So where we have investment income, for instance, combined together with the business income, for purpose of accounting, they do that. But for purposes of tax, you need to show them separately. So we have investment income indicated or included in this business income. So you're going to deduct dividend from Haki Cooperative. So dividend, Haki Cooperative. Dividend Haki Cooperative, 42,500. So you're going to deduct 42,500. So here you get the adjusted taxable income. Adjusted taxable profits to close. So when you do that computation, you get the adjusted taxable profit or loss. So we can do it. So you take 9, you can even help me, 994. You add 64,000. So the adjusted taxable income here, according to my computation here, it is 1,885,260. So that is the adjusted. So I want to delete this section here so that I can get space for distribution. So you can take a photo of these notes here. So I want to do away with this section here. So please, if you are interested, you can get a screenshot of it. So now here, you're going to prepare what we call distribution schedules, partners distribution schedule. So partners distribution schedule. So we have two partners. So one is called Mark, another one is called Wangu, and then Toto here. So here you give them the items that benefited from the partnership, their benefit from the partnership. So first of all, you give them their salary. So partner salary, salaries to partner was 450,000. So 450,000. So this one was to be shared in accordance with your profit and loss sharing ratio. The profit and loss sharing ratio is 2:3. 2:3. So for Mark, it will be 2 divided by 5. You multiply by 450,000. So Mark will get 180,000 here. So you write here 180. And the other partner will get 270. So that is the salary. You share in accordance with their profit and sharing ratio. Where did I get that kind of information from? It is from number 2, which says the amount due to partners are to be apportioned according to profit or loss sharing ratio. So any amount that is due to partners is shared in accordance with the profit sharing ratio. So another thing that you give the partners is you give them, if there is any commission to partners, you give them. So there's a commission. So the commission, the total commission is 180. So you share it again in accordance with your profit and loss sharing ratio, which is 2:3. So 2 divided by 5 times 180,000. So this is 72,000. So you give them 72,000 here. Minus 180. So the other one will get 108. Total here is 180,000. That is the commission. Another thing that you give to partners is there is interest on capital. So that is another benefit. Interest on capital. So the total is 250,000. 250,000. So you share it among the partners. 2 divided by 5 times 250,000. So this is 100,000. So this is 150,000. That is interest on capital. If there is any other benefit like bonus, you also add there. Bonus, for instance, in this question, the bonus was not there. You add there. And then there. And then you less interest on drawings. Interest on drawings. You less interest on drawings. The total interest on drawings was 45,000. So you less interest on drawing 45,000. So you share 2 divided by 5 times 45,000. So this one gives you 18,000. This is 27,000. Then here you write share of profit stroke loss. So you bring some here. So you take this adjusted profit. So you write adjusted profit stroke loss. So this here 188 260. So this 1885 260, 1885 260. You first of all deduct this salary, you deduct the benefits, and then you add the interest on drawings. So 1885 260, you deduct 440,000, sorry, 450,000. You also deduct 180,000. You also deduct 250,000, and then you add 45,000. So if the answer you get here is positive, you share it as a profit. If it's negative, you share it as a loss. So the one that I'm getting is positive 1050, 260. So you share it in accordance with your profit and loss sharing ratio. That is 2, you divide by 5, and then you multiply that. So this one will get 42, 104. This one will get 630, 156. And then you add it downwardly. So the first one is 180,000 plus 72,000 plus 160,000 plus 18,000 plus 42, 104,000. So this one is 850, 104. And then you 270,000 plus 108,000 plus 150,000 plus 27,000 plus 630, 156. So this is 1185, 156. Then now here you consider other incomes. Other incomes, specifically those ones from the specified sources of income. So we had dividend, which is 42,500. So you're going to share the dividend. So remember, when it comes to dividend, so we have two kinds of dividend. There are dividend received from companies and SACCOs. Those ones, the withholding tax is final. This dividend received from other cooperative societies other than SACCO, the withholding tax of 15% is not final. So for instance, here, they receive dividend from other cooperative societies other than SACCOs. How do you differentiate between this dividend from cooperative societies and SACCOs? So the naming will also give you the indication that which kind of dividend is that. So SACCO must have the word SACCO in it, but this one do not have the word SACCO. So once you receive dividend from that kind, so it means this amount that is indicated here, it is 85%. So you gross it. You gross it. To gross it means you ask yourself what is 100%. So it will be 100 over 85 times 42, 500. So 100 you divide by 85 times 42, 500. So that is 50,000. So you share this 50,000. So you share this 50,000 in accordance with the profit sharing ratio, which is 2 divided by 5. So this one will get 20, and this one is 30. So you get the total taxable income here, total taxable income, total taxable income. So this is 87,0104. So this is 12, 15, 15, 6. So that one brings us to the end of that question. So that is how you should have approached that question, supposing you are sitting that paper. So I'll give you an opportunity to maybe take a photo of the answer, ask questions, make clarification as before we progress. Oh, I have not seen any questions, so I assume things are okay. So we're going to look at another question. So this one, I'm going to delete it. So we're going to look at May 2019 question number 4. May 2019 question number 4, that is company. May 2019 question number 4. So we're going to look at May 2019 question number 4 on companies. So Pareto Limited has provided the following income statement for the year ended at 1st December 2018. So we have the list of incomes and expenses and the net profit there provided. Then additional information number 1, dividend comprises of dividend from Beta Limited, 505,000, dividend from Bona Cooperative Society, 170,000. Number 2, foreign exchange gain comprises of amount of realized foreign exchange gain, 125,000, amount of unrealized foreign exchange gain, 50,000. Number 3, bad debts recovered related to bad debts on sale of furniture, 130,000, bad debts on credit sales of goods, 240,000. Number 4, insurance claim related to insurance compensation on loss of profit, 380,000, insurance claim on loss of motor vehicle, 405,000. Number 5, advertising comprise advertising through daily newspapers, 280,000, advertising on passenger sheds at bus stops, 430,000. Number 6, subscription related to annual subscription fees to Chamber of Commerce and Industry, 530,000. Subscription to Employees Sports Club, 610,000. Number 7, interest comprises interest on debentures, 580,000. Interest on loan acquired to build commercial rental houses, 110,000. Interest on money borrowed to pay tax and penalties, 70,000. Number 8, legal cost comprises appeal to tax tribunal, 155,000. Defending business property rights, 120,000. And then registration of lease agreement over 100 years, 90,000. Capital allowances were agreed with the Commission of Revenue Authority at 960,000. Required, adjusted taxable income or loss for Pareto Limited for the year ended at 1st December 2018. So here we're going to write the title, Pareto Limited computation of taxable profit. Year of income 2018. And then you underline this one. So you can write here shillings and thousands. So we start with the reported net profit. The reported net profit. The reported net profit is 75.84. So you write here 75.84, they're in thousand. When you start with the reported net profit, you said you add back disallowable expenses. So you add back disallowable deductions. So you add back disallowable deductions. So where do you get the disallowable deductions? So you go to the expenses deducted for the period. So when you pick an expenditure, you also check alongside the additional notes if it is there. So for instance, salaries and wages is allowable. So you check any note that is affecting salaries and wages. So in the additional notes, we don't have any note that is attached to salaries and wages. So that one we omit, we leave it. It was okay for them to have deducted. We go to the increase in provision for bad and doubtful dates. So increase in provision for bad and doubtful dates has note number, let me see. So it doesn't have any notes, but ordinarily specific provision is the one that is allowed. It must have the word specific. So if there is any other provision that is not specific, it's not allowed. So write here specific increase in provision for bad debts. This one is not allowed. So the total amount is 145,000. So you add there 145,000. The next item is contribution to Nssf. So when you make contribution to Nssf on behalf of your employees, that one is allowable. Advertising is allowable, but there's a note attached to the advertising, which is note number 5. Says advertising comprises advertising through daily newspapers. That one is allowed. Advertising on passenger sheds at bus stop. That one is capital in nature, is not allowed. So advertising through passenger sheds, that one is not allowed. So the amount is advertising through passenger sheds, the amount is 430. So you add back 430. That one is not allowed. Stationery is allowable. It has no note attached to it. Depreciation is the next item, is not allowed. So you add back depreciation. The total amount for depreciation is 280,000. So you add back 280. Subscription to note number 6, subscription related to annual subscription fees to Chamber of Commerce and Industry. So subscription to trade association is allowable. Any other subscription is not allowed. So subscription, any other subscription is not allowed. Subscription to sports club. So subscription to employees sports club, to employees sports club, that one not allowed. Subscription to employees sports club, 610, that one not allowed. Trading loss is allowable. Interest is allowable, but there's not number 7, which is attached to it. So interest comprises interest on debentures. So debentures is a loan to the company. So interest on it thereon is allowable. Interest on loan acquired to build commercial rental houses is not allowed. So they're not doing rental business. So interest on commercial rental, on commercial, interest on loan, rental houses. That one will not be allowed. The total amount indicated there is 110,000. So you add back 110. You add back 110. Interest on money borrowed to pay taxes. That one is not allowed. Interest on loan to pay taxes. To pay taxes. Interest on loan to pay taxes. To pay penalties on taxes is not allowed. So 70. So you add that one. And then we have transport is allowable. Legal cost is allowable, but there is a breakdown of what that legal cost comprises of. It's number 8, which says legal cost comprises of appeal to tax tribunal. So appeal to tax tribunal, that one is not allowed. Appeal to tax tribunal is 155. So that one is not allowed. Defending business property right, that is capital. defending business property right. That is capital is not allowed. So 120. And registration of lease agreement. So lease agreement of over 100 years. Lease agreement of over 100 years is not allowed. So you add back 90. So there you finished. So if you check keenly, we have finished with number 5, 6, 7, 8. So you're remaining with number 1, 2, 3, 4, and 9. So after that, you less here omitted allowable deduction. Omitted allowable deduction. So omitted allowable deduction. So the only one here is capital allowance. Nowadays we call it investment allowance that was agreed. So if you've been given a block figure of investment allowance, if you happen to have the acquisition of capital items, you don't compute for individual capital items once you've been given a block figure representing all the items. So you don't go about computing for individual items. So in this question, they gave us block figure. The other question that we did, they did not give us block figure, so we had to compute for each and every individual item. Where you have been given a block figure, you just deduct that block figure of 960, like in this case. So that is the omitted allowable expense. And then we less non-taxable incomes. So we less non-taxable income. So where do we get the non-taxable incomes? We go to the list of incomes that were considered for the period. So the first one, we have the gross profit. Gross profit. So remember here, we first of all deal with the non-taxable income. So for instance, the foreign exchange gain is subdivided into two. We have unrealized foreign exchange gain that was non-taxable. So unrealized foreign exchange gain, unrealized foreign exchange gain, which is 50,000. That one is non-taxable, so you deduct here 50. Bad debts. So bad debts recovered, we have bad debts on sale of furniture. So bad debts on sale of furniture recovered, bad debt on sale of furniture. So that one is not taxable. 130, so you deduct 130. And then we have insurance claim. Insurance compensation on loss of motor vehicles, not taxable. Insurance claim on motor vehicle. Insurance claim on motor vehicle. 4 or 5. So you deduct 4 or 5. And then there is profit on sale of equipment. Profit on sale of equipment. That 188 is profit on sale of equipment, and then sale of debentures. Sale of debentures. Sale of debentures, 4,200,000. So that one is non-taxable. And then you less income from specified sources, less incomes from specified sources. Income from specified sources. So income from specified sources. So the first source of the income from specified sources We have rent received. So you deduct rent received, the entire amount. Rent received the entire amount, which is 580. So that one is, and then dividend, that is investment income. Dividend, 675. So you deduct 675. Interest for Harry Bank. For Harry Bank, the total amount is 289, so you deduct 289. So here you get the adjusted taxable profit or loss. Adjusted profit stroke loss. So 584 plus 145 plus 430 plus 280 So this is 2217. Then you add other incomes. You add other incomes that are taxable. Other incomes, this specifies sources of income. So we have rental income is, so rental income here, you're going to write here rental income. So 580, and then you're going to deduct the interest on commercial building. So you're going to deduct 110. You're going to deduct 110. And then we have a dividend. Dividend, it comprises of dividend of Beta Limited, that was withholding tax is fine. So we have been given its grace. So here, dividend from cooperative society, Bona Cooperative, that one is going to be taxed again. So that is 100/85 times 170,000. And then interest income. Interest income. Interest also net. So you're going to gross it. So to be 100/85 times 289. 289. So this one is going to be 200. This is going to be 340. So you get here, but here with the holding tax final, here with the holding tax final. So 2217 plus 200 plus 340. So this is 2757. So this is total taxable income. Total taxable income. So supposing they told you tax liability, so tax liability will have taken 30% of 2757. So that is how we do that question. This was May 2019 question number 4. So I'll give you opportunity to ask questions, take a screenshot of it, make clarifications, as we move on before we do another question. Thank you. Yeah, you can still look at it as I wait for your question. I'm waiting for a question from any one of us. If we don't have a question, then you can suggest other areas that you might want us to look at in the course of the week, and then we can as well review them. So remember, for you to easily pass this paper, you also need two areas. You need to study public finance. In case you don't have those notes, you can request for them. We can forward them to you. So you need to read. It's a combination of both theoretical and calculation. So you need to combine both theories and calculation in order for you to successfully do this. So you need to review that area of public finance, introduction to taxes, the introduction part of it. So they are all notes available. They are notes available. We can send them to you, and you can review. For now, in case of this, because there's no question, we're going to stop at that point. So my number, in case you need notes, any clarification, anything that you might be in need of. But I can't do one thing that you need to remember. I cannot do the entire past paper and send to you. It's not possible. Maybe one or two clarification here and there. So some students are giving me a whole, you want me to do the entire paper or a number of sittings. It's not possible for me to do that. I can only clarify, make clarification of a few areas here and there. Or maybe in case you need answered question, you can request for a revision guide, which is sold. That one can be of help to you, but don't expect me to answer everything for now. But for clarification here and there, you can ask for notes, new rates, anything like that kind. And then I can be able to help. So my number is here indicated. For that, we will come to our end of today's class, and I want to wish you a very good night. Thank you.